Hello and welcome to our discussion on financial accounting. In this session, we'll see a set of financial transactions and convert those financial transactions into financial statements and prepare and determine the economic value added. The set of the transactions are given here. The opening balance sheet is given here. We'll first convert these financial transactions into financial statements, then determine some of the important performance indicators like economic value added. Let us first prepare the financial statements. So the opening cash in hand is 86,000. The company issued shares to the employees, 10,000 shares of 5 at rupees 60. So therefore capital is 10,000 into 5, 50,000. So the capital will increase by 50,000. Share premium, capital will increase by 50,000. So this is 1,5. Okay, so let us make those transactions values, and there is the shares are issued at 60, so there is a share premium of 55. So share premium is 10,000 into 55, that is 5,50,000. 5,50,000. The share premium will appear on the balance sheet on the sources side. So the cash has gone up by 6 lakh, capital has gone up by 50,000, and share premium has gone up by 550,000. Sold 50% of the stock for cash, so sales is equal to 600,000. So sales is a cash inflow, sales is equal to 600,000, and the cost of the goods sold is 50% of the stock, so 0.50. So the stock of goods sold is 250,000, 500,000, and as a result the stock of goods sold will reduce the stock reduces to 250,000. Collected 90% of the money due from the debtors and the balance written off as bad debt. So collection is 90% of the old debtors, 0.90, and balance 10% is a bad debt, so 10% of 80,000. So the debtors will reduce to the extent of collection and bad debt, so the debtor will become 0. And this is collection is not an income but the reduction of debtors. Paid 90% of the money due to the creditors, so 90% of the money due to the creditors, so payment is to the creditors, so 90% of 94,000, 0.90 is a payment, and the reduction of debtors not an expense, and the balance was treated as a discount, so discount received from the creditors is an income, so 9,400 is treated as an income, and the creditors will also become 0. The debtors have become 0 because of collection and bad debt. Creditors have become 0 because of payment and the discount. Purchase know-how for 100,000. We have sufficient cash, so we purchase the know-how. Know-how is equal to 100,000, but the know-how has been amortized for accounting over 4 years. So amortization of know-how is 100,000 divided by 4, and know-how is an asset, so we'll show the know-how is an asset, so know-how will be shown as 100,000 minus the amortization, so 75,000 will be shown as know-how. On the balance sheet, 25,000 will be shown as an expense. Payment is 100,000, the expense is 25,000, asset is 75,000, so benefit expired is 25,000 and unexpired benefit is 75,000. For taxation, 2 years, so this we will see when we prepare the tax statement. Purchase plant on 1st September, so purchase plant on 1st September 200,000, so we have another asset coming up, so purchase plant 200,000 on 1st September, and depreciation on this plant is 25% for the period. So depreciation in the working, we can show depreciation is 200,000 into 0.25 multiplied by, okay, so multiplied by 7 months, September, October, November, December, January, February, March, so 7 months, so into 7 divided by 12, so 29,166 is the depreciation for the period. So depreciation is charged for 7 months. For 7 months. So it is very clearly mentioned that depreciation is for the period, and depreciation for the period is for 7 months. So the plant will reduce to the extent of depreciation. We can show the depreciation as less accumulated depreciation minus 29,167. So depreciation is an expense, no cash flow, but a reduction in the value of the asset. Depreciation for taxation is for the full year. We'll use it when we prepare for the tax calculation. Company declared dividend, but before we use this information for dividend, we'll complete the transactions. So company in which A Limited has invested, that is Z, has declared dividend 100%. A is having shares in Z Limited. The face value of the share is 5. So the dividend will be calculated on the face value of the share. So 100% of 10,000. So therefore 10,000 is the dividend, and the dividend is an income. Dividend is shown as an income. Dividend is calculated on the face value, not on the market value. Dividend is an income and inflow. Dividend is an income and inflow. So, and most important is dividend is calculated on the face value, not on the market value of the. Interest on the loan is 12% on the loan amount, 0.12. So 350,000 is the loan. So 72,000, yes. And let us assume that interest has been paid. Okay, so interest has been paid, so interest is an expense, an outflow of money. Since no other transactions there, let us find the PBT. PBT is income minus the expenses, and expenses are 354,000. We have profit before PBT, so PBT is equal to 619,400 minus 354,157, so PBT is equal to 265,233. On this we have to calculate the tax, but before we calculate tax, it is necessary to find the taxable statement, and the tax statement will show the taxable income. So we take all the items first to understand what are taxable and not taxable. The sales is same as accounting, discount is same as accounting, dividend is not exempted, is not taxable, is an exempted income. So the total taxable income, assuming that discount is also a taxable income, so the taxable total income is 609,400. Cost of goods sold, same as accounting. Bad debt, assuming that the income tax also allows bad debt. Amortization, it says amortization for taxation is 2 years, so therefore the value of the amortization is 50,000. The value of amortization for accounting is 25,000. The value of amortization for taxation is 50,000. Depreciation for taxation is for the full year. So depreciation for taxation will not be for 7 months, but will be for 12 months. So depreciation for 12 months. So depreciation for 12 months is equal to 25% on the cost of the asset. So depreciation is calculated, so 25% and 25% on the plant, 0.25, so is 50,000. So depreciation for accounting is not same as depreciation for taxation. Amortization for accounting is not same as amortization for taxation. Interest is same, so therefore the total allowable expenses for the purpose of tax calculation is 409. So the taxable income is 609,000 minus 609,000 minus 400,000. So the taxable income is TP is equal to 209. Then we'll say tax is equal to 0.30. So tax is 62,000. Tax is 62,820. According to the AS22, when the accounting profit is not same as the tax profit, we have to show current tax and deferred tax. The current tax is as per the tax laws, and deferred tax is tax on the timing difference. So the current tax is 62,000, and let us assume that the company pays the tax too. So tax paid is equal to 62,820. If not paid, we have to create a corresponding liability. And the deferred tax is the tax on the timing difference. The timing difference in this case is amortization plus depreciation minus amortization minus the depreciation for accounting. So the deferred tax is equal to the tax on the timing difference. The tax on the timing difference is because of amortization and depreciation. Amortization and depreciation are treated as a timing difference because over a period of time the difference between accounting and taxation due to the amortization and depreciation will get adjusted. So at a particular point of time there is a difference, but over a period of time there is no difference. So this CT is required to be paid, and DT is shown in the balance sheet as the liability. So DT on the DTL on the balance sheet comes from deferred tax, and deferred tax comes from the timing difference between the tax statement and accounting statement. So once we have the CT and DT, we can find the profit after tax. So profit after tax in this case is 188,663. So, and this one, the entire profit for the time being, let us transfer it to the income statement, to the balance sheet, but it is given that the company declares dividend, stock dividend and cash dividend. So we can show the distribution of dividend as below the line item. So less stock dividend and cash dividend. It is better to show this less stock dividend and cash dividend as below the line, so that it becomes easy to understand the appropriation or distribution of profit. The stock dividend is 1:2. That means the bonus shares are issued in the ratio of 1 share for every 2 shares held by the shareholders. Let us take an assumption, since it is not very clearly mentioned, that the stock dividend, okay, so stock dividend is issued on the opening stock. Okay, our assumptions. You can make other assumptions too. So our assumption is the stock dividend is on the opening capital. So opening capital, opening number of shares is equal to 150,000 divided by 5. So 30,000 is the opening number of shares. So bonus shares are issued in the ratio of 1:2. So therefore divided by 2. So the face value of these shares is into 5. So 150,000 is the original capital, and the new issue of bonus is 15,000. So therefore 75,000. So the bonus issue is a reduction of reserves, to the extent of 75,000, an increase in the capital to the extent of 75,000. So let us recap. If a company declares bonus shares, the capital will increase, and to that extent the reserves will go down. And in this case the reserves will go down to the extent of the bonus issue, to the extent of the bonus issue. Similarly, cash dividend has been declared 20%. So let us make an assumption that the cash dividend is on the opening capital. If the cash dividend is opening capital 20%, so the dividend will be issued on 150,000 into 20%. So cash dividend is equal to 30,000. So therefore cash will come down to the extent of, so cash dividend is equal to 30,000, and the reserves will go down to the extent of 30,000. So reserves will go down to the extent of 30,000. So we can examine the changes in the reserves. The reserves have gone up to the extent of the current profit, but after that we have distributed dividend, stock and cash. So change in the reserves, the change in the reserves is opening reserve plus PAT minus the stock dividend minus the cash dividend. So there is change in the reserves is because of the current profit and the distribution of dividend. So as a result, our income statement is done, and we will now find the cash in hand. So cash in hand will be equal to cash available minus the cash payments, and cash payments is 519,000. So cash in hand is equal to 848,580, and cash is an asset, will be shown on the balance sheet. So cash flow statement done, income statement done, tax statement done. We'll close the balance sheet. No change in the loan, no change in the credit, no change in the 12% loan. Creditors have reduced, DTL has arisen. So the total sources is 14,44,413. 14 lakh, okay, and no change in the shares. So the summation of this will be balancing, the sources are equal to the assets. So to recap, the changes in the balance sheet are visible through the income statement and the cash flow statement. And the income statement and cash flow statement captures the transactions of the business. Some important issues are, whenever the profit after tax, profit before tax is not same as the taxable profit, it is necessary to find the current tax and the deferred tax. And the current tax is as per the tax statement, and the deferred tax is tax on the timing difference. So the deferred tax will be shown on the balance sheet as a deferred tax liability, and the current tax will be shown as a payment if it is paid, and if it is not paid will appear on the liability as a tax payable. So therefore, with a given set of transactions, it's possible to convert the transactions into financial statements. However, it is necessary to observe and recognize that sometime the taxable profit will not be same as the accounting profit. Now with this information, we will now calculate the net operating profit, that is no PAT, and NOPAT is a non-GAAP number, so it will not strictly adhere to the profit which has been calculated as per the GAAP. So it says it's necessary to make the adjustments, and these adjustments may relate to the financing anomalies or may relate to the accounting anomalies. So therefore we add back interest as to remove the financing anomaly. So the interest into 1 minus T will take care of adjusting for the financing decision. So interest is equal to 42,000 into 0.70 takes care of the financing anomaly. We also take care of the accounting anomalies by removing the deferred tax. EVA says it will recognizes only the current tax, so the deferred tax is not recognized. So the summation of PAT plus interest plus minus accounting adjustments is the NOPAT, and here the accounting adjustment is deferred tax. So deferred tax is added back because it is an accounting adjustment, not an actual expense. So with this we can find the capital charge, and the capital charge is equity, loans, equity, 12% loan. But since there is an accounting adjustments of DT not recognized, so DTL will also not be recognized. When DTL is not recognized, we have to prepare an economic balance sheet. The economic balance sheet is required to prepare to determine the EVA, and this is not a GAAP requirement. So economic balance sheet will show most of the items that are there in the accounting balance sheet except those accounting adjustments which are not recognized. So no change in the capital, no change in the share premium, loan is same as accounting, reserves are same as that, creditors, but the DTL is not recognized. So as a result, the total of the sources side will be less of DTL. So therefore, obviously the balance sheet will not tally, and we have to make an adjustment for that. No change on the asset side, no change on the cash, no change in the debtor, no change in the shares, no change in the know-how, no change in the plant, no change in the accumulated depreciation. So the summation of this will be the assets. We can see the difference is because the deferred tax liability was not recognized. In EVA calculation, that is given a name, it's called equity equivalent, and equity equivalent is equal to, in this case, 13,750. So when we take the 13,750, so the balance sheet will tally once again. So this is an economic balance sheet which is not a GAAP driven. This will show all the adjustments which are recognized for the purpose of EVA calculation. So in this case, the accounting adjustment is only the deferred tax, and that is called equity equivalent. So equity equivalent is the accounting adjustment required to convert economic balance sheet into convert accounting balance sheet into economic balance sheet. So we take that as equity equivalent, also as the source with the cost. So equity equivalent is 13,000, equity is 275 plus 550, loan, 12% loan is 350,000, and each of this will have a cost. KE is given, it is same for equity equivalent, and the cost of debt for 12% loan is I into 1 minus T, so 8.4%. So therefore the capital charge is equal to the value into rate. So capital charge is in this case is the summation of the cost for equity equivalent, and